Hello and welcome to the Insight is Capital podcast. I'm Pierre Daillie, managing editor at advisoranalyst.com. I'm here today with Phil Mesman, partner and head of fixed income at Picton Mahoney Asset Management. We're going to be discussing event-driven investing or special situations in celebration of the firm's latest liquid alternative fund launch, Picton Mahoney Fortified Special Situations Alternative Fund.
This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Phil, welcome to the show. It's great to have you.
Hey, Pierre. Thanks so much for having me today. Appreciate it.
So, Phil, tell our listeners about Picton Mahoney Asset Management a little bit and the evolution of your alternative investment solutions and your role at the firm.
Sure. Picton Mahoney is an alternative investment manager. We were founded in 2004, employee owned. And at our firm, our mission is to help investors achieve their financial goals with greater certainty. And key to that is building and identifying solutions that are different and that can add value to investor portfolios, or what we would like to say is fortify investor portfolios. And fortifying investor portfolios is really all about identifying return objectives and combining that with, risk constraints and putting that all together and to maximize total return and minimize risk. And we're very excited that we've been managing those type of solutions in the equity space, income space, multi-asset space, and merger arbitrage as well. I joined Picton Mahoney in 2009 to build out the income business. And the income business, our flagship strategy, which we launched at that time, our objective was to provide a corporate bond-like return with less volatility than corporate bonds. And very pleased with our results over that 11 plus years. And really, it's a corporate bond-focused strategy. So we look at corporate bonds in developed markets. And we organize the portfolio a little bit differently than what you might see in traditional bond strategies. We have 3 segments, and then we overlay hedging. And those segments include what I call patient capital, and that's coupon clipping and defensive corporate bonds. It provides an anchor of a portfolio. And then we combine that with special situation investing, which is what we're going to talk about more today. It's event-driven credit investing. And then in addition to that, we have single name shorting, which is where you would short a corporate bond because you think it's expensive or you think that there might be some kind of challenge with the company. And then we overlay those 3 segments with hedges. And the hedging aims to protect the portfolio from interest rate risk, currency risk, credit volatility, liquidity risk, and those kind of things.
Great. So, Phil, we know this is a tough environment for bond investors. Can you comment on what you're seeing in the fixed income market right now? And follow up, I guess, where do we go from here?
Sure. Yeah, it is absolutely difficult for bond investing in general. And the main, crux of it is that the yields are very, very low globally across all asset classes within fixed income, government bonds, corporate bonds, et cetera. And so it's difficult to get that income for investors. And they're used to getting, very consistent income and in fact, great returns from fixed income for the last decade. And kind of, stepping back, ask the question, okay, well, what is income investing and what are you aiming to get from it? The objective from income investing is to get income and then also to get the protection of bonds, to get that downside protection. And when you look at the low yields we have today, it's going to be very difficult for traditional bonds to deliver in this environment. And that's creating a strong business case for alternative income investing. And I would say that the one of the strongest business case I've seen in my career for alternative income investing is today, given these challenging income markets.
Yeah, it's really created quite a conundrum. There's so little room to move, given how low yields are, and given the sort of growing persistence of an inflationary outlook. And so, Phil, as a bond person, if you were in an advisor's shoes, what would you do with your fixed income?
Yeah, I'll address that first. I want to talk about that room to move in inflation. And when I look at the risks today, the main risk in fixed income in my mind today is margin of safety, or room to move, as you call it. Margin of safety means, is there enough yield cushion or credit spread yield, let's call it, to handle volatility? And that yield is so low, it doesn't matter whether the volatility comes from inflation or from corporate spreads widening out. And so that is the challenge for sure. And on the inflationary front, I think reasonable minds can differ whether we will or won't have inflation, but it doesn't take much to hurt. In other words, yields don't have to go up very much for you to feel volatility in your bond portfolio, given how low yields are today. So with that, the question is, okay, what do you do about it? If I was an advisor, as a bond person, with all humility, if I was in advisor's shoes, what would I do? The first thing I think is critical is stepping back and just taking inventory of what you own in your bond book and looking how it all works together. So I like the idea of bucketing everything between core and plus fixed income. So your core fixed income would include government bonds, investment grade, et cetera. And then your plus gets into high yield and then perhaps emerging market bonds. So just kind of bucket those and then look for your overlaps. And I really like the idea of zero basing, where, take a look at everything you own, but take a blank piece of paper. And if I were to say, okay, if I could give you $100 today, what would you buy in fixed income? And with that, take that. And when you have that answer, go from where you are and work your way back to that. And to me, finding a few strategies that do different things and work well together is really what you want to do. And I believe key today is process. Resiliency of process is critical. So spending a fair bit of time talking to the managers that you empower with your capital to understand their process and asking them, how are you going to make me money in this environment? How are you going to protect the portfolio given how low yields are? And those kind of questions, I think, are critical and as part of the process.
You've also talked in the past about using or comparing the yield versus the duration. Can you talk about that a little bit and how useful that is?
Sure. So yield divided by duration is, I think, one of the most important stats to look at for your fixed income. It's how much money you're going to make is your yield, and divided by duration, which is how much risk you're taking. And basically, when you look at that stat, it's at the worst risk reward in history for fixed income, worst-ish, I should say. So you have very low yield and very high duration. And so understanding that and understanding that risk is key in making sure you have a view on it.
Thank you. It's bond
Let's
math.
keep going down bond math. I love it.
I think one of the things is that investors, probably the majority of investors feel that bond investing is a very mechanical, very arithmetic strategy, when in fact there's a lot more fundamental homework that's required, as in equity investing, as in traditional equity investing, particularly value investing, has used fundamental analysis to determine the valuation of stocks. Your approach also uses fundamental analysis to determine the fair value for bonds and the fundamentals behind those bonds, the coverage, those sorts of concerns. And that's the kind of homework you're doing behind the scenes. It's not strictly, it's not so much an equation, which I think a lot of people think it might be. It's a lot of intuition and fundamental analysis and fundamental research that goes into your decision making.
Well, I think fixed income managers have overcomplicated fixed income forever. It's a big rouge to try to make it sound like mystique. Fabozzi, who's the Picasso of fixed income, if anyone has read any of his books, or have had to read any of his books, I should say. We have several definitions of duration, several definitions of yield, but at the end of the day, it isn't that complicated on the math side. There's only a few variables that matter, but fundamentals are critically key, as you're highlighting here, for sure, especially today.
So which brings me to special situations. Let's talk about special situations credit investing. How does that work? What's involved in that?
Sure. So stepping back, special situations credit investing, big, I should say, in the market globally. Very, very little representation here in Canada, but it's a big category within fixed income outside of Canada. And when I look at my career, I started out working at Scotiabank in commercial credit. And I'd like to think that I bring a banker's perspective to the bond market.
Right.
Then I spent time at Merrill Lynch working as an analyst in our special situation investments. So we would have proprietary investments at Merrill Lynch in Toronto. And I was the analyst on some of those names. And then I went to a hedge fund in New York, Grey Wolf Capital. And in fact, at Grey Wolf, their flagship strategy was special situations. So I spent a lot of my career working on it. And when I moved back to Canada and I joined Picton Mahoney to build out our income business, I really appreciated the combination of this concept of special situations with patient capital, and putting that together makes for really a dynamic fixed income strategy in my mind. It really, very simply put, is event-driven credit investing. So some kind of event happens within the credit markets, and it's our job to jump on it, analyze it, get under it, and figure out if there's something to do for investors. And it involves forensic analytics. So, imagine actually reading financial statements, reading the covenants of the bonds, and seeing if there's an opportunity within those bonds. And I would say the best analogy I could provide that I think would be maybe a little more accessible for our investors, because they might be more familiar with it, is merger arbitrage. So merger arbitrage on the equity side involves, one company buys another company, and then the merger arbitrage investor goes and looks at those companies to see if there's an opportunity there to make some money. Same kind of idea. So there's, on our side in the event-driven credit investing, let's say a merger is a great example. Company X buys company Y. We jump in like analytically, like a SWAT team on company Y, right, the acquired company, have a look at their financials, have a look at the covenants, identify if there's an opportunity within the bonds. And it's very much about process. It's all about, jumping in, having a look, digging deep, formulating an investment thesis, putting the investment on, monitoring the investment, and then unwinding it at the outcome.
Does this type of environment that we're in make it difficult to find the investing opportunities in special situations, or does it help?
I think there's always something to do. The bond market is huge, and really it's an evergreen type of strategy. It's been a key part of our overall fixed income strategies since our onset in 2009. So that's been through many different market regimes since then. And I actually really like this market for event-driven credit investing. In fact, I think event-driven credit investing represents one of the best risk-reward opportunities in all capital markets today. Because yields are so low, it's actually encouraging companies to do stuff. So it's encouraging companies to buy other companies. So an investment grade company buying a smaller high yield company, for example. It also encourages refinancing a debt, taking out big coupon debt and issuing new bonds with lower coupons and less covenants.
Right.
And so we're seeing a lot of action, a lot of activity on the event side. And in fact, we've tilted our broader portfolios away from patient capital and more into event-driven credit investing because we see more opportunities on that side. And to me, the patient capital or the broad markets are expensive, but within the markets, there are some amazing opportunities, and particularly on the event side.
I want to ask you about some, if you can share some sort of prime examples of special situations. But before I do that, I want to ask you also if you can sort of define patient capital.
Sure. So again, the patient capital formulates, I would say, the anchor of our broader fixed income portfolios. And it really is just coupon clipping and corporate bonds. The intention is to get that steady income with low volatility, and it provides that key income within the book for fixed income. It complements event-driven investing very well. So event-driven, it also involves income, but more importantly, you're looking for a capital gain and a higher total return from that investment. Right. So our flagship strategies are the combination of patient capital, special situations, shorting, and then hedges. And what we've done with our new launch of our liquid alternative special situations fund is we've isolated that special situation segment and pulled it out as its own standalone strategy.
So what are some prime examples of special situations or event-driven that you can think of?
Sure, there are many. We have several subcategories, and so it includes merger arbitrage, as I talked about before.
Right.
Recapitalization, so a company changing their capital structure, refinancing debt. It would also include things like regulatory changes. So we've seen some regulatory changes, particularly in the banking sector, which has been a big contributor of ideas for the last 11 years. ever since the financial crisis. And in addition to that, perhaps a rating agency changes. So an upgrade trade. So an investment going from, or pardon me, a company going from high yield to investment grade. When that happens, the yield on the bond goes down. And here's the bond math again, yield. So when a company goes from high yield to investment grade, the yield on the bond goes down.
Right.
And when yield goes down, price goes up and you make money. So you get a capital gain. So the upgrade trade is likely the best example I could think of. Conversely, on the short side, the downgrade trade is a source of alpha opportunity as well. And, kind of going back to we didn't talk a lot about the short side, but to me, given these low yields, we're actually seeing a lot of interesting short side opportunities and see that as a potential alpha source going forward for investors.
So speaking of special situations, there's one special situation right now in China that's dominating the news. And that's the Evergrande debacle that's unfolding. What are your thoughts on that?
Yeah, it's a big special situation.
Yeah.
That credit represents around 15% of the high yield market in China. So that's a big one. And the question is, and this is a really good example of our process. So it's interesting to me that it's so everyone's so attentive to it today because this has been happening for quite a while. So those bonds of the company have been steadily going down for several months. And it all went back to the original source was the regulators, China, basically wanted to restrict the amount of leverage in a lot of companies. So they wanted to have them reduce leverage in general. And Evergrande ran into trouble because they had too much leverage on the balance sheet. So now we have this situation where, okay, here's an event. And the question is, okay, what do you do about it? So Evergrande is in trouble. First thing we do is we unpackage a business. So we're not involved in the name, but we would unpackage it and understand its implications to the broader market. So what is the follow through trade? So my whole thinking, and this is all about special situation investing, is you can't predict something to happen, but don't miss it. So something's happened. Now what's the follow through? What sectors are going to get impacted? So that's the analysis that we did. So we spent time looking at what sectors could get impacted, and a lot of raw material sectors get impacted, obviously, given the housing nature of the business. In addition, the financial sector could get impacted, is getting impacted in China, and then could get impacted elsewhere. So that's the type of trades we'll put on the back of this. So we'll look for short side opportunities within sectors that could get impacted negatively because of this news event. And then in addition to that, I think the broader markets have been somewhat complacent about the information and have been for a little while. And I think complacency is, part of that margin, lack of margin of safety risk. And so in addition to these sector ideas, we would also look to the broader markets for hedging purposes and for potentially macro alpha like purposes. So shorting perhaps the high yield market as well, or the investment grade market.
That's great. So, Phil, where does a special situation strategy fit into a portfolio? Is it income or is it absolute return?
It's a bit of both. So our broader strategies, again, aim to provide a corporate bond-like return with less volatility. So when I talk to an advisor or to an allocator, we talk about it as being that corporate bond replacement category within their allocations. This is a little bit different. The objective of special situations is to provide equity-like return with bond-like volatility. So looking for a little more return. And therefore, I believe that if from an allocator's perspective, you should fund that purchase by reducing perhaps your high yield allocation and your equity allocation. So taking a bit of both and applying it to that category.
Thank you, Phil. That actually really clarifies it. I think that would be one of the sort of leading advisor questions, leading investor questions, in terms of exactly where it fits. So Phil, where can we learn more about Picton Mahoney and more about special situations credit investing?
So you can go to our website, pictonmahoney.com. If you're a financial advisor, reach out to one of our sales reps here at the firm. You can also email us at support@pictonmahoney.com.
Awesome. Phil, thank you so much for your valuable time. It's been really enlightening. And I know our audience will have a lot to take away from this discussion. Thank you so much.
Great. Thanks, Pierre. Appreciate it.